Good afternoon, and thank you for joining us for today's Market Update webinar. My name is Darcy O'Brien, and I'm the Chief Marketing Officer at Simon Quick, and I'm pleased to be moderating today's discussion. This year has been challenging from the start, as inflation and rising rates have pressured markets through the first 3 quarters of the year, and markets continue to remain volatile here in October. Both stocks and bonds are down, while unemployment is at historic lows and relative domestic economic strength has made the US dollar arguably too strong. Many of our clients are feeling bewildered by this challenging market environment and are looking to us to provide some guidance and insight. For today's webinar, we're going to begin with some prepared remarks and market commentary, and then I will open the floor to Q&A. Please use the Q&A function on Zoom to submit your questions. I will be monitoring the inbox, and questions will be answered in the order in which they were received. I'd also like to mention that this call is being recorded and will be posted to our website and circulated over email tomorrow. Now, before I introduce our panelists, I'm going to read a brief disclaimer. This presentation is for information and discussion purposes only. Please remember that past performance may not be indicative of future results, and there is no guarantee that the concepts and ideas discussed during the presentation will be profitable or prove successful. Now, let's introduce our panelists. Today, we have with us our Chief Investment Officer and Managing Partner, Chris Moore.
Hi, Darcy. Thanks for having me.
Hey, Chris. And we also have our Head of Investment Research, Wayne Yee.
Hey, Darcy. Good afternoon.
Good afternoon. Thank you both for being here. So to set the stage on what we're seeing in markets, I'm going to pass it over to Chris to make some opening remarks, and then Wayne will provide some market commentary.
Great. Thank you, Darcy. And thank you for all of you that have joined us today. For those of you that are new to participate in one of our webinars, we generally put these together to supplement the content that we're regularly distributing to you all. Particularly during periods of market stress or volatility, where we're certainly seeing a lot of kind of questions come up that we think the broader group would certainly benefit from hearing answers to. We've over the last few weeks in particular met with a number of clients and are reviewing a lot of the factors contributing to market performance today. And we've tried to put together some content that we think will certainly supplement, as I mentioned, the information we've distributed previously. But we do want today's session, as Darcy said, to be very interactive. So please feel free to submit questions in the chat, and then we will try to get through as many of them over the course of our time here today as we can. Just before I turn it over to Wayne, a couple comments I'd like to make as we, think about kind of where we started the year and where we are today. I think the word that I would use to most describe this year as an investor is challenging. That's really been the case as we look through all capital markets, whether it's public equities, private equity, public credit, private credit. Unless you were sitting in cash or unless you were buying treasury bills, there's really been nowhere to hide. And as we think about why that's been the case, a couple of things that we would highlight. Certainly, as we came into the year, the expectations were for the Fed to increase rates, for the Fed to address a higher inflationary environment driven by both an increase in demand and supply chain constraints. I think what was most surprising about this year was certainly how stubbornly high inflation has been. And because of that, the Fed has really been forced to increase rates at a much more dramatic fashion than many had predicted coming into this year. Despite, as we kind of look back at the last 4 quarters, despite our view that, we had reduced some equity exposure at the end of last year, we'd gotten more conservative within equities earlier this year, reduced kind of our duration risk. None of that was enough. And none of it was enough because of the speed at which inflation continued to move higher. And then, of course, the Fed had to respond aggressively to that stubbornly high inflation. And now Fed is really committed to maintaining that course. And that's wearing on markets, right? That's brought multiples down. It's brought rates significantly higher across fixed income markets. And now markets across the board are just waiting for a point at which the Fed all of a sudden says, we're going to pause here and see what happens, or we enter a recession type scenario and then ultimately work our way through the recession and ultimately to a point where the Fed is forced to pause because the slowing is so dramatic. So as we we'll get through some comments that we put together here today, and we'll give you further indications as how we're thinking about markets going forward. But to tease that a little bit, our consensus really is we're staying the course. We're not backing up the truck and doubling down on equities by any means. But as Wayne will get into, certainly if there's fresh cash going to work today, and we're thinking 2, 3, 4, 5 years out, we do see now as an entry point for equities and a good place to be putting capital to work that is in fact longer term capital. What we're certainly monitoring any future events in the market that the market is not necessarily pricing in yet, and that's how we're thinking about risk management across asset allocation and incorporation of fixed income and alternative exposure. So I'm going to turn it over to Wayne, who's got a number of slides that he's going to get to, and then I know we've had some questions submitted already, so I do want to get right into the questions after his commentary.
Great, thanks, Chris. I'm going to keep this relatively quick, and definitely we can follow up after the call. But to Chris's comments, interest rates moved up dramatically and very quickly, and those are the two factors that really made diversification not have any true value in this market. If you look over time, interest rates, gradually rising interest rates, are actually positive to equities. You'll see periods where equity markets actually are positive in rising rates, but it's the pacing at which within, let's go, 3/4 of a year, you've seen 3 points of rate rises. And that in itself is really dramatic, especially given the base at which we started off of, at essentially 0% interest rate. So you can see that impact here. The blue are equities, the gray are bonds, and then the dark blue, those are commodities, they're called gold, oil, and what have you. And you can see the blues down to a meaningful degree, mid-20s to 30. The grays, the stuff that should be defensive versus equities, they're also down mid-teens in some instances. So that's where the lack of where diversification did not really work, because things were still down in that double-digit framework. And kind of turning to the next slide, why is that? And this is where you see a lot of people talk about, well, the 60-40 of equities and fixed income are dead and no longer valuable. I mean, in this market, you could see the negative impact of it over the long term. We do think that there still is value to high quality bonds versus an equity portfolio for diversification. But and what this chart shows you, the orange line on top, that's the historical kind of drawdown or loss rate of fixed income, investment grade fixed income, the benchmark essentially. And you can see that it was very consistent, very small drawdowns. This is going back to 2000, so over 20 years, while the dark blue line, that's equities. So you can see the big movement in equities in these periods. And in the chart right below, what that points to is correlation, or how much does stocks and bonds move in the same direction. Over the long term, stocks and bonds move in at a really low kind of relationship at 0.11 on this chart, 0.2 for if we just want to take a benchmark number. But right now, we're seeing a 0.75 out of a 1 to -1. You're seeing a 0.75 positive relationship, and the magnitude of that is what's really hurting in this environment. We do expect that relationship to normalize again over time. However, in this correction, as rates have moved up as dramatically as they have, you've seen a positive correlation that unfortunately is to the downside. Next slide. And why? Because the Fed is really looking to tamp down inflation. So inflation still at 8% plus, it's too high. Core inflation, which includes rents, non-core inflation, which includes energy and food, all that is just, if it kept up at this pace, it would be untenable. The Fed doesn't have a lot of tools, so the few tools it does have, raising rates being one of them, has been the main driver to higher rates to try to slow down inflation. You're seeing a little bit of it, but it's not enough. We're still at 8% plus. and the other element is unemployment. The economy is still really strong. We're looking at 3.5% unemployment, which is really low. And the Fed is willing to give up on unemployment or allow for greater unemployed people in order to slow down this kind of spending dynamic or the high rate dynamic. So that's really what's the Fed is trying to address inflation by higher rates, and that's a knock-on effect into stocks and bonds. Next page. So really quickly, this is that sudden rise that we saw in 2022. And I just kind of show you where we were historically in 18. Powell tried to raise rates in 18, and we saw that. 2018, market sold off in December. Bonds were actually the only thing that broke slightly positive. I think it might have been actually flat on the year, but equities were off a few points. But if you look back in time, we're not going back into the 80s, but even to that pre-GFC period, Fed funds in that 4% plus range, like it's been around there. So we are going back to what long-term historical normals. It's just we're going there so quickly, and that's what's causing kind of capital markets issues. So maybe just final slide to Chris's comments. We do want to still maintain a diversified allocation, allow for balanced portfolios to work for us over the long term to weather through this volatility. While in the short term it doesn't feel great, we do think long term this will still work. We like the balance of both. Growth has oversold. We think there's been a lot of pressure on growth. We don't think it's going to just rip back or bounce immediately because there still is interest rate pressure. But we do want to be balanced on growth versus value, but more domestic focused. There are some opportunities within small and mids because they're kind of historically cheap, even from a comparison to large caps. But we do like diversified exposure within equities. Fixed income, we've been short duration. We've been slowly and steadily increasing that duration component from the benchmark is about 6.5 years. We're probably moving that more to about 4, or we have moved that to about 4 over the course of the past couple quarters, but moving up in credit quality as well to allow for kind of recession protection. But alternatives have gotten a lot more interesting. Higher rates, higher volatility allows for hedge funds, residential real estate, other private opportunities to really show their value. It's not the ostrich putting its head in the sand to avoid the volatility. Rather, I think there are dynamics of kind of a higher borrowing environment, creating more volatility, allows for arbitrage and multi-strategy hedge funds to find more things to do in this environment. Residential real estate is a hard asset that is inflation aligned, and we could talk about kind of the cyclicality of real estate as well. Private equity, the marks have stayed high. However, we do think over the long term, the active engagement in differentiation versus generic public markets will still play out. But in the near term, we think secondaries and distressed are really interesting because the recession is not yet here. We don't think it's necessarily kind of really here, but things will get softer. And secondaries, people that need to sell, being an opportunistic buyer and providing liquidity to others to participate in private equity gains, we think is attractive. So we'll end the prepared comments here, and I think we'll go into questions.
Great, thank you, Wayne. So questions have already been rolling in. We're going to do our best to keep the webinar to 45 minutes, but if we are still receiving a number of questions from participants, we will go to the end of the hour. The first one in is from David, and he asks a question on many of our minds. How bad is it? I don't see how we can have a recession without unemployment.
I can take that one. I think how bad is it, to put it into context, I would highlight, quite frankly, the performance in the bond market, right? And the aggregate bond index is about down 16-17% year to date. S&P down 24, I think, through Friday. S&P number is certainly a shocking number, but I think the performance of bonds generally is really extraordinary. I mean, it is a multi-standard deviation move. We haven't seen this kind of negative performance out of bonds since 1979. And actually, some of the data we've been throwing around recently, the 60-40 portfolio, 60% S&P, 40% Barclays Ag, hasn't performed this poorly since the mid-1930s. So it is market performance is really, really bad, certainly, in bond markets. I think the S&P number honestly isn't telling the entire story. Some of the mega cap stocks that make up the majority of kind of the, call it top 10, top 15 stocks in the S&P, a lot of those have performed much better than some of the more growthier oriented names. Wayne just showed the data, but there are stocks in the NASDAQ that are down 60, 70, 80, 90%. It has certainly been an incredibly challenging year, and all public markets are feeling the pain of that. As I look at kind of the economy, how bad is it? Inflation, CPI at 9% year over year as of June of this year, that's a bad number. Core CPI, even though CPI has trended down over the last 3 months, core CPI has been stubbornly moving up. And that is definitely what the Fed is focused on as they continue to raise rates. Core CPI is just ex food and energy. So we are all feeling the cost of higher inflation, right? You feel it in your wallets when you're filling up your car at the pump. You feel it in your wallets when you're in the grocery store. If you're shopping for clothing for you or your kids, everything is more expensive. If you go out to a restaurant, it's more expensive. We're just feeling the higher inflation everywhere. And the Fed in particular is focused on labor markets because unemployment, as Wayne just mentioned, has been stubbornly low. The Fed has been transparent in communicating that they're willing to see unemployment move higher and have folks certainly be out of the workforce to benefit the economy more broadly and prevent kind of stubbornly high inflation for too long. So our view is that the impacts of higher unemployment working their way through the economy are still ahead of us, quite frankly. So the good news is I think that has been communicated by the Fed, and certainly market participants are appreciating that. The second comment I would make is on the cost of real estate, whether it's renting or owning real estate. That is a component of CPI as well. And the Fed is looking for the impact of that data to be less on a go-forward basis. Hence, rates moving higher, driving mortgage rates higher. So those two factors we think still need to get worse before we really see the full impact of the higher rate environment. But the last comment I would make is as we look at consumer sentiment, I think it's at a 40-year or 50-year low. We look at cash on the sidelines, it's the highest it's been since 2008. We look at certainly sentiment on Wall Street and sentiment on Main Street, very, very negative. So we are all feeling certainly the challenging environment that we're in today. And I think as investors are trying to assess how much of it's priced in and what surprises might await us going forward.
Thank you, Chris. Our next question is from Megan. How are private investments holding up in light of the sell-off in public markets?
Yeah, maybe I'll take that one. When you look at, let's call it private equity versus public equity, generally, private equity has held in better. Maybe you're seeing marks on the year down 10, 15%, and that's kind of, it looks better optically when you're comparing that to S&P down 25%. I would say there are a few components of that in the vein that public equities have been performing at a tremendous pace over the past few years, 20 to 30% type returns over the past, let's call it 5 years or so. And that's in the midst of a COVID situation as well. So I would say there's probably been more gains that were made in public markets versus what you saw in privates. Now, with that headline comment, I think there's a big range in there in the vein that private equity, traditional private equity buyout, like you buy a company that's cash flowing and kind of high quality that you're trying to optimize, those are probably the most resilient versus growth equities, companies that are about to come to the IPO market or go public. Those were the ones that saw tremendous corrections. And to Chris's comment, looking at some of the IPOs and recent tech companies that are down 50, 60, 80%. That's what some of the growth, pre-IPO growth stocks were aiming to do. So you definitely see some much more dramatic impacts on that front. So yes, public markets are doing worse. Private markets are not immune to it. We do expect some continued valuation adjustments lower over the course of the next couple of quarters. Fundamentals have generally held in. The economy overall in the US is still pretty resilient. And we're seeing that from the second quarter earnings. We're seeing that third quarter earnings. That's partly one of the reasons why the Fed is willing to continue to push rates higher. But so we're seeing that kind of still generally healthy dynamic in private credit and private equity, but it is softening. We're keeping an eye out on that. Public markets just have repriced really quickly ahead of that.
Thank you, Wayne. Our next question is from John. How do we think about cash management, and how does cash fit as part of an asset allocation?
I can take that one. This is a very different question today than a year ago, certainly because cash was pretty much yielding nothing a year ago. Now you can buy short-term treasury bills yielding 3 or 4%. As we kind of look back on this year and where we are today relative to the beginning of the year, in hindsight, certainly a larger allocation to cash would have helped us. As I mentioned at the beginning of the call, I think we, like many others, did not expect the pace of the interest rate hikes to be as dramatic as it has been. For investors today and how they should be thinking about holding cash, we are of the view that if you need funds in the next 6 to 12 months, those funds should be in cash because you can actually get paid for them today. But certainly looking beyond 12 or 24 months, we're very much of the view that there are greater opportunities elsewhere to be investing where you can generate a higher after inflation return. Cash is certainly a safe place today, right? It is principal protection and it's got a decent yield on it. But we don't view cash as kind of a long-term investment play beyond any short-term liquidity needs. I think it is for investors that want to be more allocated to cash, you would need to have a really kind of negative view of the short term and the potential for further declines in equity and fixed income markets. We are not of the view that there is significant pain ahead of us in the short term. Certainly there could be more volatility. Certainly there could be more surprises. But the risk to kind of selling now, investing in cash, and then buying back in is there are a couple of ways to get that wrong, quite frankly. The first is if you're selling, you're likely selling something you've held for the last few years, which in many cases is going to have significant gains embedded in it. Selling out of that investment, you're going to have to pay cap gains taxes on it. Most of our clients are taxable investors. So you're paying at the federal and the state level for many of our clients. And then secondly, you're going to have to perfectly time your reentry point. So it's not just about getting out at the right time, but it's about getting back in at the right time. And there's more than enough data to support that whenever markets turn, the point at which they turn can be just as dramatic on the upside. And, we're seeing today markets rally and you could have a up 3 or 4% day in equity markets versus, a treasury bill that's yielding that over the course of a year or more. So it's really dependent on what your needs are for that capital.
Thanks, Chris. Our next question is from Bill. How will this election cycle impact the market, especially if there's a potential red wave of Republican seats won?
Yeah. So this year, I believe the entire House, every 2 years, the entire House is up for re-election. You'll have, I think, roughly about a portion of the Senate also up for election. And not being a political expert, there'll be better commentary around this, but I do think that there is the potential of a split, let's call it Congress, where of the two houses, one can hold on Democrat, the other may shift Republican. Generally, a divided it's called administration between the presidency, let's call it the White House, Congress, and let's leave the justices aside. But between those two, a divided administration leads to more deadlock, and frankly, the markets appreciate inability for moving forward. So this is purely a capital markets comment, but in these deadlocks, it just creates more stability. So technically, the market, if you look back historically, the market should probably take that as a positive. But that's just looking historically in terms of what it might look like. I do think there's been a lot more commentary about even whatever the Republicans do win, there's still a lot of disjointed views within the Republican Party between let's call it the moderates and those that may be a little bit further right leaning. And that in itself is something that they're going to have to address, even if they were to win one of the houses. But generally, the overarching comment is that in an election year, divided governments are historically positive to capital markets. The only other comment, we did have the Inflation Reduction Act that had just been enacted. Maybe it has been about a month or so. So that's supposed to be kind of positive or long-term strategic for the economy. I do think a lot of the political agenda right now is focused a little bit more on non-market and probably a little bit more geopolitical more than anything else. I think that's kind of where the focus on the next couple of years will probably be.
Thanks, Wayne. Our next question is from Martin, and it pertains to real estate. In real estate, rising rents benefit the income component, but how will that affect occupancy rates? Could we see a housing crisis, and how would that affect our real estate allocation?
Yeah, maybe I'll touch on that. Just on the research side, on the investment side, we did approve a residential real estate fund over the past couple months. We do like residential real estate as a good ballast with its kind of asset inflation characteristics, as well as income components that offset or maybe even more attractive than what you get in a traditional fixed income bond. So these are leaning a little bit more into income-oriented residential as opposed to kind of big development projects or what have you. We do think this market and this cycle, the dynamics right now look a lot more attractive than the kind of 2008 housing crisis where there was a excess supply in terms of houses on the market, way too much financing ability for the consumers, the ninja lows, no income, no job applications. So there was a lot more negative dynamics in 2008 than what we're seeing right now, where there is still a lack of housing. And higher rates also causes potential buyers to not be able to buy at the same rate, and maybe they're more willing to negotiate, or sellers are more willing to negotiate housing prices. So you can see home prices come down because of higher rates, but the investments that we look towards to are investors that own assets and generate income or rental income off of those. And that demand has still remained really resilient and strong. Occupancies are still in the mid-90s, if not higher. We look towards kind of secularly long-term growing markets to be able to be exposed to. In a recession, yes, there will be some shaving off, but residential real estate, let's call it multifamily, single-family rental, things of that like. We're also doing student housing. In that vein, these segments tend to be much more resilient than obviously the retail or hotel. Office is still going through a transition post-COVID. So we do like that segment of the market as a more defensive way to maintain exposure, even in a recession.
Thank you, Wayne. Our next question is from Grant. Are you reluctant to use the term stagflation?
Yeah, I could take that one. I mean, stagflation obviously is a period of higher inflation, slower growth. I mean, I think we are in a period of higher inflation, slower growth. I think the question is more so about for how long does this last? We are not of the view that this is kind of an extended period where we're going to see kind of CPI at 8% and core CPI at 6%. I think we're of the view that inflation is likely going to be higher than, call it, the 1.5% to 2.5% we've been used to seeing post 08. Could it be, high twos, low threes? Certainly. Could it be, high threes next year or 4% next year? Definitely. I think what we're more concerned about is that we start to see some easing of the inflationary data, such that we can get to a point where the Fed can kind of slow the path at which they're hiking rates, and the economy can soften and then normalize. Wayne, anything you want to add there?
Yeah, no, I agree with that. And the scary thing is that the Fed is really trying to fight inflation specifically, and expects that to go into an economic slowdown, which we're seeing the elements of. We are seeing a slowing of the economy, just nothing, just not at the pace that the Fed wants. But inflation, we do expect inflation to come down. We expect interest rates to stay higher than what we've experienced over the past 5-10 years. There could be economic challenges in the midst of that, but over the long term, we think it does normalize. It's just this washing and return to historic normalcy that we're trying to get to. But really, the Fed's trying to avoid a stagflationary scenario, and that's why they've been so aggressive on the hiking that we saw thus far this year.
Thank you both. Our next question is from Holly, and she asks, what are Simon Quick's thoughts on cryptocurrency?
Yeah, we view, or even prior to here, we viewed crypto and blockchain as technological innovation, which falls alongside the lines of the NASDAQ, as opposed to a newer currency that might fall along the lines of US dollar or gold. So in that vein, higher risk, higher return. While we appreciate the long-term benefits of how blockchain may be able to benefit certain use cases, it's still so nascent with new and growing players, and still trying to find the appropriate business and economic model. So we've been slowly dipping in rather than saying, here's a big asset allocation call. Rather, it's, okay, it could be an opportunistic element that aligns towards something like a venture capital. And we see a lot of our venture capital funds have elements of blockchain or in that ecosystem portfolio companies. So we view it from that perspective, as opposed to long-term, it can be transformative, but I think it just needs to have greater, larger, more reputable buy-in. It's happening slowly and steadily, but it'll still be really choppy over this time. It feels worse right now because the market has gotten bigger. The economy of crypto has gotten bigger versus what we saw in that 17-18 period, where it was such a kind of garage or kind of attic kind of computational kind of exercise. There's more businesses being based off of it now. So it feels a lot worse, and you're seeing institutionalization, which actually can cut to the negative, like financing or kind of 3 arrows and kind of situation like that. But just if you look at the index of crypto, it's kind of behaving like the 17-18 period.
Thanks, Wayne. Our next question is from Amit. With recession talks getting more active in the last few weeks, how are you convincing investors to stay invested or to get money from them? Mostly people want to sit in cash at this point in time.
Yeah, to put the first part of that statement in context, I think there was a Wall Street Journal poll of 12 economists just in the last week that set their kind of recession prediction at a 63% likelihood. I might have the numbers slightly wrong, versus 48% just a couple of months ago. So certainly the talk of recession is much more widespread, and I think more likely. As we kind of think about, what happens if we go into recession, truthfully, we want to see the rate hikes work their way through the system. And that means a slowing. That means unemployment spiking. That means risk-taking slowing down. We're likely going to see a lot of kind of public company CEOs and their CFOs deliver guidance that's pretty weak on a going forward basis, reflecting certainly higher rates and higher inflation that's working its way through the system. I would also not be surprised if we see kind of the financial services, banking, asset management, investment management universe lay off more people as we get close to the beginning of next year to reduce costs around certainly a very challenged year. We've already seen a lot of tech companies announce their plans to slow hiring or in some cases reduce headcount altogether. As we think about, well, what does inflation or what does recession mean and how do we respond to that? It's less a question of if or not we get into recession. It's more a question of when we get into recession, how bad is it? And is there a second shoe to drop, so to speak, in that scenario? We're of the view that a recession would likely be modest and mild, and one that the economy is strong enough to weather through, albeit painful maybe in the short term. We're not of the view that it's kind of a global financial crisis 2.0 or tech bubble collapse 2.0. And I think the second part of the question was, how do you get investors to put money to work? It's really helping investors think beyond the next 2 to 4 quarters, helping investors put kind of this decline in perspective, right? Markets decline 20% every 7 or 8 years. There's ample data to support kind of how the recovery looks 12, 36, 60 months out. And the further out you go, the higher the probability is that the dollars you put to work today are more valuable then. So helping investors kind of put their portfolio into perspective and not think about what's happening in the short term or what's on the TV today. Certainly the inclination to sit in cash, there's an opportunity cost to that, right? We talked about this in 2008. We talked about it in 2020. There is an opportunity cost to sit in cash and not have to worry about the volatility of your portfolio. And that is up to kind of every investor and their respective advisor to determine, what the price is for that opportunity cost. How much are you willing to miss out on just to not have to withstand further volatility and further concerns in the world? And I think that price is different for everyone.
Thank you, Chris. Oh, did you want something to add there, Wayne?
Yeah, maybe one comment on that too is we are not here saying, hey, equities is the only way to go. Like we are presenting a diversified asset allocation approach here. And in that model, how can that break? That could break if interest rates are moving up. Let's look through the rest of this year. Let's say 4% in 1 year. Like, yeah, we wish we were better at calling that rate cycle, but to see another 4% rate hike, that's extreme. And even if we're trying to be really conservative, saying maybe it's a 2% within 1 year, like that, I still think is a pretty aggressive case. And still, and I put it unlikely, but if that were to still be the case, bonds do not lose mid-teens percent in that environment. Equities are already down 25%. So we are already approaching what I would call the lower levels. I mean, I think it's extreme in bonds, but even in equities, I think we're approaching lower levels historically. We do want historical precedent we want to work alongside historical precedent versus saying that this time it is different. We're aware of what's going on in the world, but we do think that there is a balanced approach and there's tilts within it. There's defensive cash flow generators that are sticky regardless of recession or expansion. They'll be slower on the recovery, but they'll be more resilient on the down. We're in floating rate adjusted income strategies that will be able to ride up higher rates and kind of move alongside as opposed to having interest rate exposure. So there are lots of different pieces. It doesn't have to be I buy equities or not. It is that diversified approach that we do think is long-term accretive in this environment, even if we were to enter a recession.
Thank you both. The next question is from Peter. Would you consider some commodity resource-linked energy exposure to participate in a period of structurally higher inflation?
I'll jump in on that. We are. We have been spending some time in the commodity space. We do have a manager in the hedge fund side that plays. It's a macro fund, so it plays in everything. Rates. We can talk about rates as well. Rates, FX, commodities. So it plays a whole gamut. And in that vein, they've done well in this environment. I want to say it's up about 20% or so on the, depending on which vehicle, about 20% or so on the year. We're actually shaving a little bit of that back because it's been so strong, but we've had some commodity exposure there. We are looking at relative value within commodities as well. And this is still exploratory. We're still spending time on it, but we don't want to call the directionality of cyclicals because that's really hard and that could be short-term and transient. So you might make the call and then the market turns. And if we are heading to a recession, commodities actually do weaken. So what we want to do is find ways to play kind of volatility in some of these asset classes, because we do think higher rates will create more volatility, which means long, short, or pairs trading. That becomes a lot more interesting, and you can do that in the commodity space as well. So we're exploring and looking to see how it balances out traditional corporate exposures.
Our next question is, with all the news in energy, is Simon Quick doing any work around commodity, energy, renewable specific ideas?
Yeah, maybe just that, I guess that piggybacks off the comment I just made. Commodity/energy, I kind of loop it together. And renewables kind of falls into technology as well now. So when you're looking at a lot of technology companies, kind of solar, wind, biodiesel conversion, all that stuff is now becoming more of it's energy, but it's technological innovation within energy. So you are seeing that kind of spread out a lot. EVs continues to be a thing. So we are not going whole hog into that. We think it'll take time to grow out, but we do think it is expanding over the long term. The energy crisis that we're seeing in Europe, while it's more painful right now because Europe was so focused on getting more solar and less reliant on oil and gas. So it just shows you the importance of having some of those kind of still kind of, let's call it dirty energy right now. But it kind of creates the need or the necessity to find other alternative sources of energy over the long term, and that is the long-term driver. But long-term driver, meaning it's not just going to happen in the next year or two. So we are steadily, incrementally looking at opportunities, but it does kind of spread out to other sectors beyond just energy or tech.
Thanks, Wayne. Our next question is from John. Sticking with the commodities discussion, what are your current thoughts on gold?
Christian, I'll go, or should I take this one?
You're on fire, Wayne. Take it.
This is how I get myself in trouble. Gold actually down. I think in that chart, I think we showed it, that it was probably down maybe like 9% or so, which is really interesting because it should be inflation aligned. I think over the long term, you can see how gold can be, it generates maybe like S&P like returns. Now, we're talking over multi-year cycles, but there is a volatility to it. There is negative correlation, but there is or kind of low correlation, but there is a high level of volatility in a very specific asset class. I would rather, if we think about portfolio allocation, making a gold call in itself is probably a stretch. We'd rather want it to be part of a more diversified metals, materials, energy, agricultural type allocation than one specific asset or one metal within that bucket.
Thanks, Wayne. Our next question is a two-parter. There's been a lot of cocktail party talk about investing in an I-bond fund this month. What do you think about this strategy? Another strategy is to move cash into a high dividend yield ETF. Does Simon Quick have something like this? Or should I just purchase 20 individual stocks within or adjacent to my portfolio, i.e. AT&T, Coke, J&J, ExxonMobil? On your call, you mentioned medium to small stocks. Would you stay away from the larger stocks?
I can take that one. First addressing the I-bonds, they're probably not right for most investors just because there is a very low limit for the amount of I-bonds that you could purchase. I think it's $10,000. As far as the allocation to stocks go, there is certainly a quality tilt within high dividend oriented stocks. Wayne mentioned kind of our focus on quality within equity exposure. We do have a heavy allocation to kind of income oriented stocks that are high quality. Those are generally stocks that perform well during periods of market turmoil. As we think about dividends and playing a significant, part in the total return approach going forward, there are a lot of sectors that we certainly like there, and certainly post GFC, financials in particular have been increasing their dividend payouts. We have used a number of different strategies to get that exposure. Some are active, some are passive. Within the more passive approach, we have kind of a tax loss harvesting strategy that's worked well for us there, because you're able to get certainly equity-like returns while harvesting losses during periods of volatility. But then the comment about small and mid cap, do we stay away from mega cap? We're not staying away from mega cap. I mean, in fact, we probably have more mega cap exposure just because it tends to have a lower beta. I think Wayne's comments were more a function of mega cap tends to be most sensitive to the dollar and further appreciation in the dollar, whereas the smaller capitalization stocks would be immune to that. We've seen them perform quite well, especially in kind of the last 6 weeks relative, to some of their larger cap stocks. Wayne, anything you want to add there?
Yeah, maybe just to clarify my comment, mid and small cap stocks historically, if you look over time, have historically, or let's call it small cap specifically, had traded at a premium versus the S&P. We're at a period where small caps are actually trading at a discount to S&P, and maybe let's call that cyclical risk because they tend to be kind of less diversified, less resilient, but they've been benefiting from being domestically oriented businesses that have done well in this period. We do have some small cap exposure within our equity portfolios. We like them as a complement as opposed to being an outright conviction bet. There are, if I look at equities, like the Russell 3000, about 10% of the Russell 3000. So if you just look at all domestic stocks, public stocks, about 10% of the index is in that small cap bucket. We're roughly around that. I would say maybe we tilt a little bit more defensive with that allocation, but we don't want to forget about the opportunity within small caps. But to Chris's early comment, large caps, mega caps, yes, dollar sensitivity, but better balance sheets, more resiliency, more levers to pull in periods of softness. So there is a defensive element to large caps generally that small caps may not. Mid caps are a nuance to this whole story. That's probably worth another webinar on its own. But there's elements of that we appreciate that, but we align that a little bit more to the small cap side than the large cap side.
All right, the next question is from Susan. What will come back first, equities or bonds?
I can take that one. It's a good question. I think as we think about which asset class would rally first, it really depends what's happening in the world. If all of a sudden we start to see inflation decline and some rhetoric from the Fed that they're potentially going to pause their rate hiking, it wouldn't surprise me to see equities, rally harder than bonds. However, if we're in a scenario where there's a flight to quality due to some geopolitical event, whether that's, in Russia-Ukraine situation or China-Taiwan, that scenario would likely lead to, rates, quite frankly, performing better and bonds appreciating because there's a flight to quality and less a function of, the Fed repositioning and markets moving higher in response to lower inflation. So this is why we have a diversified portfolio, right? This is why we use asset allocation to deliver the risk-adjusted returns that our investors are looking for, because certainly the future is very much unknown and a lot can drive asset prices. Wayne, anything you would add?
Yeah, I think that's a really interesting question, and I think it really, we'll probably have to kind of make a call on what we think the economy is going to do first. And off of that, we should be able to say what the Fed will do. And once you get to that point, then you can say, okay, well, these are how asset equities or fixed income will behave. And to Chris's comment, the Fed is really running towards this 4% hike this year, so that they don't have to do it again next year, or they don't have to do anything like this again. Equities are probably in the environment that the Fed gets this right and the economy does soft land or just kind of glide paths because corporations are overall doing well. Equities will have that first initial kickback, because I would say that equities are probably oversold in that environment. But longer term, fixed income will be the more defensive, lower volatility. I don't want to make fixed income doesn't make that. It's hard for both asset classes to just kind of rip back in short term, in short order, back to where they were, let's call it mid last year or late last year, only because we're not going to reset to a 0 rate environment. We are resetting to a 2%, like roughly 2% rate environment. So that does cause the fixed income market to kind of have a lower floor than where we originally were, but with lower volatility. Equities can move beyond that floor. However, it'll probably take longer to get there. It'll take more time to get there. Fixed income and equities, they're both interest rate sensitive. And if you really talk about equities generically, you could almost make the case that you can make the case that equities are actually more interest rate sensitive because you're thinking about 20, 30-year type cash flows as opposed to just 5 to 7.
Thank you, Wayne. At this time, there are no remaining questions in the queue, so we're going to go ahead and wrap up. I'd like to thank everyone on the line for taking some time out of their day to participate in today's webinar. And special thanks to Chris.
Thanks, Darcy.
And also to Wayne Yee. Thank you both.
Thanks, Darcy.
As a reminder, we will be circulating the webinar recording over email tomorrow, and it will also be posted to our blog. Thank you again for joining us, and please have a great rest of your afternoon. Bye-bye.